A 28-year-old is 3.7 times more likely to become disabled before age 65 than to die. Yet here's the coverage gap. 85% of working adults skip private disability insurance entirely, while 70% own life insurance. And buried in that gap is one clause, 6 words, that decides whether a $2,400 monthly tax-free check arrives if illness or injury stops you from working. Before this video ends, I'll show you exactly what that clause is, why it replaces 55% of your income when you can't work, and why millennials are the most financially exposed generation when it comes to this specific coverage. So let's start with the 3.7x gap. The Social Security Administration and the Society of Actuaries ran the numbers. A 28-year-old today has roughly a 25% chance of becoming disabled for at least 90 days before retirement. Their chance of dying before 65? About 7%. So disability is nearly 4 times more likely to happen. But here's what's wild. Most people buy life insurance to protect their family if they die and skip the coverage that's nearly 4 times more likely to actually trigger. 85% of working adults don't have private disability coverage. Meanwhile, 70% have life insurance. That's the coverage gap, and it's a 3.7x mismatch between risk and protection. Now, why does this matter specifically for millennials? The median full-time millennial earns about $55,000 per year. That's roughly $4,580 per month in gross income. A solid disability policy replaces about 55% of that, so around $2,400 per month. And here's the part most people don't realize. When you pay the premium yourself with after-tax dollars, the benefit lands tax-free. So $2,400 tax-free is actually closer to $2,900 of pre-tax income. That's not a luxury. That's rent, groceries, student loans, and health insurance premiums while you physically cannot work. Oh, now most millennials I talk to say the same thing. I have disability insurance through work. And yes, about 71% of private sector workers have access to some form of employer-sponsored long-term disability coverage. But here's what that coverage actually looks like. Group LTD typically replaces 60% of income, capped at around $5,000 per month. Sounds fine. But dig into the details. If your employer pays the premium, which most do, the benefit is taxable. So that 60% becomes closer to 45% after taxes. On a $55,000 salary, that's about $2,475 per month, before tax. And here's the real kicker. Most group policies switch from own occupation to any occupation after 24 months. That means after 2 years, the insurance company only pays you if you can't do any job. Not just your job, any job. So if you're a marketing manager making $75,000 and a back injury means you can't sit at a desk, but you could theoretically work as a greeter at a retail store for $25,000, they can cut off your benefits. Because you can work, just not your actual career. This is where we close the loop. The 6 words that decide everything. Unable to perform your occupation. That is the own occupation definition. And it's the single most important clause in any disability policy, especially if you're in a specialized career. If you're a surgeon earning $300,000 and a hand tremor means you can no longer operate, an own occupation policy pays you the full benefit. Even if you could technically teach biology at a high school for $50,000, your occupation is surgery. You can't perform it. You get paid. Now, there are 3 versions of this definition. True own occupation, which is the gold standard, pays you no matter what else you do. Modified own occupation, pays you only if you're not working in another field. And any occupation, the weakest version, which is what most employer plans downgrade to after 2 years. If you're buying individual coverage, you want true own occupation. It costs about 15 to 25% more, but it's the difference between a policy that actually protects your income and one that has more escape hatches than a reality TV contract. Now let's talk about what a good policy actually looks like for a 28-year-old. 4 key features. First, Benefit period to age 65. This is how long the policy pays you if you're disabled. You want it to last until retirement age. Second, 90-day elimination period. That's your deductible in time. The first 90 days of disability, you don't get paid. 3 months of expenses in your emergency fund covers this gap. Third, COLA rider, cost of living adjustment. If you're disabled at 30 and receive $2,400 a month for 35 years without inflation protection, that $2,400 buys a lot less by age 60. A COLA rider increases your benefit by 2 to 3% annually while you're on claim. At 3% annual compounding, $2,400 grows to about $6,700 per month by age 60. That's the difference between scraping by and maintaining your standard of living. Fourth, residual or partial disability rider. This pays you a prorated benefit if you can work part-time, but earn less due to your disability. This is critical because most disabilities aren't all or nothing. If you can work 60% of the time but lose 40% of your income, the residual rider replaces a portion of that 40% gap. Without it, you'd get nothing unless you were completely unable to work. Now here's the cost reality. Individual disability insurance typically costs 1 to 3% of your gross income. So on $55,000, that's roughly $45 to $140 per month. You're paying about $100 a month to protect $2,400 a month of tax-free income. That's a 24-to-1 ratio. Show me another financial product with that kind of leverage, and here's why 28 is the sweet spot. Premiums are locked in based on your age at purchase. Buy at 28, you're paying 28-year-old rates for the life of the policy. Wait until 35, and your monthly cost jumps about 30 to 40%. Wait until 40, and it nearly doubles. There's also the insurability issue. At 28, you're likely healthier than you'll ever be. Once you develop a condition, even something minor like controlled blood pressure or a herniated disc, insurers can rate up your policy, exclude that body part, or decline you entirely. Getting approved at 28 locks in your health status. Getting approved at 35 with a health history is a coin flip. So here's the strategy. If your employer offers group long-term disability, take it. It's usually free or heavily subsidized. But understand it's the floor, not the ceiling. Layer an individual own occupation policy on top to cover what group doesn't. This is especially important if you're in a specialized field: medicine, law, tech, engineering, skilled trades. If your income depends on specific skills, training, or credentials, and any occupation policy is not adequate protection. Period. One more rider to mention, the Future Purchase Option, or FIO. This lets you increase your coverage as your income grows without requalifying medically. At 28, you might only need to insure $4,000 of monthly income. But by 35, if you're earning $120,000, you'll want to insure more. The FIO rider guarantees you can do that regardless of health changes. Now let me address the most common objection. I'm healthy. I don't need this. The reality, according to the Council for Disability Awareness, is that 90% of disabilities are caused by illness, not injury. Heart disease, cancer, mental health conditions, back disorders. These aren't things you can prevent by being careful or young. And the average long-term disability claim lasts about 34.6 months. That's nearly 3 years without your full income. 3 years. Can you cover 3 years of expenses on 45% of your income? Most millennials can't even cover 3 months. So let's summarize why this matters. A 28-year-old is 3.7 times more likely to need disability coverage than life insurance before 65. 85% skip the coverage that's more likely to trigger. A good own occupation policy replaces about $2,400 per month, tax-free, when you can't perform your specific job. And that 6-word clause, unable to perform your occupation, is what separates a policy that actually protects you from one that has a dozen ways to deny your claim after 2 years. If you're in your late 20s or early 30s, this is the window. You're young enough to lock in low premiums, healthy enough to qualify easily, and far enough from retirement that the math overwhelmingly favors coverage. Disability insurance isn't glamorous. It's not a conversation starter, but it is the single most effective income protection tool most millennials will never buy. Don't be part of the 85%. If this was helpful, there's more on the channel.